welcome back to the channel. Today we're starting at the very beginning. Most people treat the stock market like a casino. They're looking for a lucky number or a hot tip. But if you want to actually build wealth, you have to stop looking at tickers and start looking at businesses. Today we're defining exactly what a stock is and how it changes your financial future. The ownership mindset. There's a famous quote from Peter Lynch: behind every stock is a company. Find out what it's doing. That is the ownership mindset. When you buy a share, you aren't just buying a digital line on a screen that goes up or down. You're becoming a partner in a productive enterprise. You are hiring the CEO, the engineers, and the sales team to work for you while you sleep. Technically, a share is a legal contract. It's a piece of paper, although mostly digital now, that says you own a slice of everything that company does. If they invent a new technology, you own a piece of it. If they sell $1 billion worth of product, you have a legal claim to a portion of that cash after the bills are paid. You aren't just an observer, you're a stakeholder. The lemonade stand model. So think of it this way. Your neighbor has a lemonade stand that makes $200 a year in profit. They want to buy a second stand, but need $1,000 to do it. They don't have the cash, so they split the business into 100 shares. You buy 10 of them for $100. Now, you don't have to squeeze a single lemon, but every time a cup is sold, 10% of that profit belongs to you. Scaling it up to a company like Apple or Amazon is exactly how the stock market works. Why does a company like Tesla let regular people buy in? Because growth is expensive. To build a gigafactory costs billions. By going public through an IPO, a company trades ownership for capital. They give you a piece of future profits in exchange for the cash they need to build that future today. It's a trade. They get the fuel, you get a seat on the rocket. Every stock starts private, usually owned by the founders in a garage. Then venture capitalists jump in. But the IPO is the grand opening for us, the public investors. Once it hits the secondary market, the New York Stock Exchange or the NASDAQ, that share can change hands thousands of times. Our job isn't to care about who had it yesterday. It's to care about where the company is going tomorrow. Wealth comes from two places. First, appreciation. As the business grows, your 10% slice of the lemonade stand becomes worth way more than the $100 you paid. And second, dividends. This is when the company has extra cash and just sends it to your brokerage account. It's the ultimate passive income because the business earned it, not your physical labor. Look around your house. If you use an iPhone, drink a Coca-Cola, or wear Nike shoes, you're already a customer. Why not be an owner? When you own these companies, you're benefiting from the smartest minds in business. Every time someone walks into a store and buys their product, a tiny fraction of that transaction is working its way back to your net worth. The father of value investing, Benjamin Graham, said the market is a voting machine in the short term. People vote with their emotions. fear, and greed. But in the long run, it's a weighing machine. It weighs the actual profits and the actual value of the business. If the business grows, the stock eventually has no choice but to follow it. History is on your side. The market has returned about 10% a year on average over the last century. That includes wars, recessions, pandemics. Why? Because humans are innovative and companies want to make money. If you can stay in your seat and ignore the daily noise, that 10% compounding math is the most powerful tool you have. If you take one thing away from this, let it be this. You are an owner. Don't evaluate your portfolio based on what the price did today. Evaluate it based on how the business you own, or businesses that you own, are performing. Are they selling more? Are they innovating? If the answer is yes, your job is to simply wait. I personally am a fan of baseball as a sport, even when my team is down. That is why I can resonate with this quote from Warren Buffett based on an article by Ted Williams, The Science of Hitting. Buffett said, "You don't have to swing at pitches. You can just watch pitches come in 1 inch above or 1 inch below your navel, and you don't have to swing. No umpire is going to call you out." By this, he means that we don't have to push action to be successful. We don't need 1,000 stocks in our portfolios. We just need a handful of really fantastic companies at fair valuations to make an incredible impact in our financial futures. In the next video, we're going to talk about why those prices move every day and how you can use that volatility to your advantage. If this helped you see the market differently, hit the like button. Let me know in the comments. What is the first company you ever wanted to own? I'll see you in part 2.